Hey traders, Raghee here, and in this free recap video, I'm going to walk you through a setup in crude that I think is going to apply to a lot of situations where the market might have rallied or sold off in a major way, and you're wondering when the correction or the retracement may begin and how to take advantage of it when there's a lot of uncertainty about how much further the market can go. Now, there are certain tools like the price movement range and for the hour and the daily that could insinuate or at least indicate where exhaustion could be waiting. But how about proof? Instead of buying exhaustion or selling exhaustion, how about proof where we can buy momentum? Well, first of all, what does that even mean? If you're looking to buy exhaustion, that means you're looking at a support zone here. This one happens to be identified by 2 previous Darvis levels, so I've automated that process, but you're looking at a zone created by Darvis. And in that zone, the expectation is, as it has happened before, that there could be buying support, the market stops in that little zone and then moves higher, or at least stops moving lower. Well, there's another, and that would be exhaustion, but there's another way you could look at the market, and that is, what about if the market decides to stop making lower lows, consolidate or congest, and then proves by breaking higher through a resistance level that there is momentum to the upside? Well, we're seeing early examples of that right now in crude on the 5-minute chart. So notice we had a downtrend. The market went neutral and broke through the top line of the wave, and there's a few other things we look for, but in a nutshell, this is what's known as a trend reversal or a trend switch. And now we see we're going sideways. Well, some of understanding the timing is knowing where the catalyst may be. What would be a catalyst for a market moving higher or lower? Time of day, economic events, all sorts of things could be a reason for the market to move higher. Right now, time of day is probably the problem. We're after the Wall Street bell is rung. We're at the later part of the U.S. trading day. If there's going to be a catalyst, it's going to occur now in the Asian session or European or UK. So there's a timing element there. Another thing to watch would be things like volume. Another thing to watch would be things like different economic events that could suggest there's risk appetite. Therefore, a stronger stock market could mean a stronger crude oil market. We have a really nice correction on the weekly. Again, consolidation perhaps within this zone on the daily, and a 5-minute that seems to be giving us a very, very early kind of a canary in a coal mine type tip or insight into perhaps this 65, 64.80 area becoming a level at which the buyers will catapult prices higher. So I'm keeping a really close eye on this one. So what happens here is, look how narrow this zone is. It's actually fairly wide for a typical 5-minute, but you essentially have here about a 30-cent area between about 64.55 and 64.85, this area where you can take advantage of the move higher. So your risk from a 64.85 or 64.88 entry is, say, 64.45. All right, so you're talking about, give or take 40 cents, right? Now, 40 cents is a whole lot less than the width of the support on the daily. This is a whole dollar. So if you entered at 65.80 and then again at 64.80 or 64.85, that's a whole dollar. You can take advantage of that same 64.85 entry and use today's current low and minimize that to 40 cents. Another thing you can do is look at options. And these are the kind of strategies that once you understand how market price action is consolidating or congesting, might be slowing down the downtrend, so it makes sense to maybe get aggressively bullish. These are things you can do really only with grab candles. There really isn't another tool that's going to give you as sharp and clear an insight into the shifts of market sentiment and trend. Going from red to blue to green, this little area here of less than 2 hours has really given us where this market is showing early signs of potential strength, and then also you can use the stop of the near-term low. I don't have that sign here yet on the daily. It's still quite bearish. The weekly chart is still actually quite bullish, trading down into the 21 EMA and the 34. But remember, each individual time frame brings with it a certain amount of risk you have to assume. Shorter term time frames, less risk. Longer term time frames are more risk. But I am a bull, especially going into and out of the OPEC meeting, because so much negativity by way of the increases in production are, I think, already discounted or baked into the cake. And I think the only way to go from here on out is up. From a macro perspective, we have way too many countries who have a vested interest, like the Saudis, in prices heading higher. I don't think the narrative has changed all that much. And of course, OPEC could get right down to the meeting and say, well, we'll keep the production increase possibility in mind, but we're not going to have to do it, or we won't do it now. And you'll see how quickly crude oil could rally on that news.